In this 30 plus data series, the Euphoriaometer has never been as high as it is right now.
We're pretty deviated from the 20 and the 50-day moving average, which is another reason I think over the next couple of weeks that we're going to get a bit of a correction, probably back to the 20. So maybe come back down to 6,000, maybe go to 5,900.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my good and euphoric friend, Lance Roberts.
I wouldn't say euphoric. I'm in the Christmas spirit, but not euphoric.
Well, the market is euphoric.
Yes.
This was an easy word to pick for this week. So the moment you and I are talking here, Lance, S&P is now at about 6,100. If it hasn't already hit it yet this morning, it was dancing with that right before we hopped on here.
Yep.
Look, I'm going to try to share a couple of visuals here to make a point or two about just how euphoric the market's become. All right, Lance, so there's something called the Euphoriaometer, which I didn't even know existed, but it says here it's a combination of forward PEs, the VIX, and bullish sentiment. And in this 30 plus data series, the Euphoriaometer has never been as high as it is right now. In addition to that, we've got, let's see here, we've got the wall of worry just basically seems to be gone. And how do I know that? Because this guy named Lance Roberts just pinged me today on Twitter.
I sent you that for our conversation today. That was why I pinged you.
Okay, good. Glad you did. And let me just pull up your tweet here and explain to folks what you were saying. So here we go. Lance Roberts, recession expectations are dying along with the bears. And basically you can see here, again, the wall of worry is going away. As everybody remembers, coming into the end of 2022, everybody and their brother expected we were going to fall into recession. And it took probably a little over a year or so for folks to, the majority of folks, to stop worrying about the recession. And now the estimated recession probability is back, near on the more historic low side of things. Also here, probability of a U.S. recession coming in the next year has been declining now since 2022, expectations of it. Goldman looks like their current forecast is even leading the pack down here at only a 15% probability. So I've got a few other visuals, but I'll take a beat here, especially since you wanted to share this one. Pull it up.
Actually, could you go back to the last chart you just showed? That was the reason I actually sent you this chart, so we get to discuss it today. If you look back at 2018, 2019, recession probabilities were very, very low. Nobody expected a recession, and then you had one in 2020. In 2022, a very high percentage of people expected a recession. You didn't get one, and now we're back to levels where they're fairly, pretty much no economist right now expects a recession next year. And anything that you look at certainly suggests no recession in the next 12 months. The reason I sent you this is very reminiscent of Bob Farrell, who was one of the great Wall Street technicians of all time. He had 10 rules, and his number 9 rule was when all experts agree, something else tends to happen. And this is just that kind of one of those points that is worth just kind of, remembering. Everybody's very euphoric right now. Everybody's optimistic. I've got a couple of charts to share with you as well on this front, which does set the market up for a bit of disappointment next year. So as we start getting ready to go into next year, and we'll talk a little bit about portfolio rebalancing needs and some other things, there is certainly some risk next year that I think investors should be aware of. We had just a good example of this last night. We had a client event, and we had a group of our clients together for kind of an end of the year event. And, everybody was very happy with portfolio returns this year. Man, this is a great year. I'm very happy. And man, y'all doing a great job. And everybody I talked to, I'm like, temper that expectation, because next year, is probably not going to be like this year. I would expect more volatility. I would expect lower returns. And so, it's great to have these really good years where portfolios are up, 20%-ish. That's great. But don't forget that for every present that you get, there's often a takeaway at some point.
Yeah, and that's sort of the theme that we're building here, which is that expectations are very high right now. And to your point, when everybody's on that very euphoric side of the boat, usually that guy's rule kicks into play, and something different than what the majority expects happens. Just like it did at the end of 2022, right? Everybody was super convinced we were going to recession. Didn't happen. All right, so just as a few other additional signs of this euphoria, rampant speculation is back. We had another cryptic roaring kitty tweet that was put out earlier this week. That caused a pop in the main meme stocks. No surprise, I think, to anybody. The CEO of AMC then immediately rushed out to do an equity offering based upon that pop in the stock. So we're kind of right back to the craziness, that we saw back near the end of 2021. We also just had, you remember I'm not going to explain why she's has become well known, but the Hawk Tuah girl. Did you see that news about the Hawk Tuah coin that they just released?
Yeah, but and again, this is very reminiscent of speculative cycles. So just remember that.
Exactly. That's why I'm specifically why I'm mentioning this is we're back to these kind of crazy extremes. And again, no surprise to anybody watching from the sidelines. That Hawk Tuah coin, meme coin, it looks like a classic kind of pump and dump, right? They got a bunch of people in, and then immediately, there was a rug pull, and it's already crashed in terms of its price. There was well, here, I'll let you talk about that, then I'll bring up something else.
Because just to your point, where we are right now in the cycle is so reminiscent of where we were back in 2021. And if you remember back in 2020, 2021, right, we had, the Fed was doing QE, we had $1,500 checks. You couldn't go to a casino to gamble, you couldn't bet on sports, so everybody started betting on the stock market. So we had record IPO issuances and when Wall Street couldn't get enough IPOs to market in time, they started doing SPACs, which were easy ways to get companies out there so people could throw money into them, even though they didn't have any investment opportunities. They just if give me some money, I'll find something to buy with it later. Remember, Kathy Wood was in the headlines every single day. She's
Right.
art funds, and she's all over CNBC and everything else. It was all about disruptor stocks at the time, and of course, meme stocks, AMC, GameStop, all that was going on. And then in 2022, all that went away. And yeah, while the market was only down 20%, all of those assets that everybody was chasing, from Bitcoin to meme stocks to SPACs to disruptors, they lost 70, 80, 90% of their value. They were completely wiped out. Well, here we are again. And it's just very interesting because, we've got Michael Saylor all over, CNBC talking about how Bitcoin is now a way to take, your real estate and transfer it to Zambia so you don't have to pay taxes on it or something like that. And just coming up with all these kind of crazy ideas. And, we've got 0-day option trading, going off the roof, leveraged ETFs. They are issuing out a record number of single stock and leveraged ETFs to meet demand, because there's so much demand right now for investing, right? Anything that's got risk in it or leverage. And it's really interesting this time because, if you go back to 2021, we saw a big rise in margin debt. Well, you're not seeing a big rise in margin debt this time. It is going up, but not to the degree we saw previously, because now instead of me taking out a margin loan on my account, I don't have to. I just buy a 3x levered ETF, or I buy stock options, and I get the same leverage. And so you don't see that rise in margin debt, but underneath the surface, we have just a tremendous increase in leverage. And I'm not saying that this is all going to end the same way it ended in 2020, but this is all going to end the way it did at some point. And all of these speculative investments are going to lose some, most, or all of their value. It's just a function of time.
Okay, and that's the key point I want to dig into with here. And I know that you recently wrote a piece on this exact topic, so we're going to get to that in just a second. One other bit of data I want to pull up here, just because it's something that you predicted. We just got the latest consumer sentiment data, and the headline here is that Trump's victory sparks the biggest jump in consumer sentiment since Clinton in 1992. You had basically said, hey, that's going to happen, and it's also going to happen in the small business surveys, and we've seen similar jumps like this. So everybody is beginning to feel better and happier here, right? And some people might say, hey, well, why is that a bad thing, right? And I think the reality is well, you can get too optimistic about where things are going, and given the levels of high degrees of speculation and levels of euphoria that we're seeing in the markets, that's starting to make some market observants nervous. And one in particular, if you haven't already seen this, Lance, is your buddy Ed Yardeni, right? I don't want to call Ed a perma bull, but he's
call him my buddy because I disagree with him quite often.
I know. You bring him up a lot usually as a foil, but Ed has been very bullish, I would say, over the past 2 years, a consistent bull. And to his credit, markets have followed what he's been predicting. But even Ed just came out and said the following. He said, for the here and now, there may be too many charged up bulls. And he said, contrarian indicators are turning bearish, suggesting the new year might start with a stock market pullback. So I just thought that was notable because, Ed doesn't really mention concerns like that all that often. I should also note too that he said, look, if this pullback happens, I expect that to be a good buying opportunity and you should buy into it, expecting higher prices from there. But it's even notable that, again, somebody who's sort of been looked at as a bullish cheerleader for the market is saying, hey, whoa, let's slow our roll here a little bit.
Yeah, and then conversely to that, David Rosenberg, who I have great admiration for, known him for about 1 billion years. He just actually wrote a piece just this past week talking about, hey, I've been bearish and the markets keep going up and I have to reassess my value. So this market is now dragging in. If you've had a bearish attitude, the market is now just basically beating you into submission, which is typical about the time that you start to see a market reversal. So it's those kind of contrarian moments are things worth paying attention to.
Yeah, they are, and kind of that is the job of what do you want to call it? Not so much a bull market, but like a blowout top or a mania, right? It's to break the bears and to get the last bear standing to capitulate, and then that's usually when the market reverses, right?
No, you had it right to start with. That is the job of a bull market. A bull market will run until there is literally nobody left to buy. And that's the important thing. I mean, Sam Stovall from S&P said this a long time ago, so that when everybody's bought, there's nobody left to buy. And what drives markets higher is an imbalance between buyers and sellers. And what that means, when I say an imbalance between buyers and sellers, if I have an equal balance of people willing to buy and sell, right, the price is going to be flat. And this is one of the mistakes that a lot of people make about, the analysis that I see in the markets is like, well, everybody should just buy an S&P index fund. Right? Just buy a passive index. Well, in theory, if everybody, let's just assume everybody owned an S&P index fund, the market would be flat because you'd have no buyers and sellers, right? And so what drives prices up or down is an imbalance between the buyers and the sellers. So when markets are going up, you've got more people willing to buy than you've got people willing to sell. And so the sellers are going, yeah, if you want to buy my shares of NVIDIA, you're going to have to pay, a higher price for them. Conversely, when everybody's bought, the seller goes, hey, who wants to buy my NVIDIA? And the buyers go, yeah, I got enough. I'm good, right? I don't need it. So then the seller goes, well, I'll tell you what, I'll give you a discount. And then when that occurs, other sellers go, oh shoot, I better get out there and sell my stock now. And now you've got this rush of sellers and buyers going, I'm not buying here, right? I'll buy from you at, $10 lower, $20 lower. And that's how you get corrections in markets. So it's very important, you brought up that Euphoriaometer here a second ago, and that's something that is important to pay attention to. We run a similar model in our weekly newsletter called the Fear Greed Index. And it's pretty much the same thing. It doesn't, I don't use Valuations, because valuations are a function of price. So this is, and one of the problems I have with like the CNN Fear Greed Index is that it uses the index to measure the index.
Right.
So what I wanted to do was create a measure of things relative to what's driving the price of the index without including the index, right? So I want to say, I want to build a model that says this is what the index should be doing because this is what everybody's doing behind the scenes. And so, but even that level is now getting up. I haven't run it for this week, so I'm sure it's more bullish. I'll run it tomorrow morning. But we're already in extreme greed areas here. And typically, we can certainly go higher from here. We've certainly gone before, but we're certainly starting to reach levels that historically have led to short-term corrections, market pullbacks, or deeper corrections. And there's certainly arguments to be made for a variety of those outcomes next year, not between now and the end of the year. I do have a reason why markets may pull back over the next 2 weeks, and we'll talk about that in a minute. But I think next year we could see, one, maybe two, 8 to 10% drawdowns next year.
Okay. So, it's important to note that that's the job of a bull market, is to pull the last bear in. It's also important to note that that's the job of a bear market, which is to make the last person just give up on, say, I'm never touching the stock again, right? And I think that's an important, when we were in the depths of 2022 near the end, you and other folks that I was interviewing who were capital managers were saying, hey, you were saying, look, the long-term bull trend is still intact. It hasn't been broken here. And more importantly, as the market keeps going down, I'm not getting calls from people saying, screw it, sell everything. I'm getting calls from people saying, hey, is this the bottom? Is this when I should deploy my cash? So exactly. It was a good marker back then that we, that the bear market, that the decline in 2022 might reverse, right? Because there was still a lot of bullish sentiment there. This one feels to me, and correct me if you feel differently, but like, I think there were more bulls still standing around at the end of 2022 than there are bears standing around now here at the end of 2024.
Yeah, it's maybe, one thing, and you'll remember this, we had this conversation at the end of October of 2022, and you and I were on the show, we were talking about this, and I was like, everything's very bearish. And I said, but and I actually wrote an article about this as well, saying, here's some reasons why the market should start rallying from here. And that was really three reasons. And one was stock buybacks, right? Which we've always talked about. Yeah. Two was sentiment. Sentiment was as negative as, here, let me just show you this. Go back to that chart I just showed you a second ago, and you can actually see this visually. So this chart goes back to 2006. And what you'll notice is this kind of red and green shaded bar. This is the sentiment of the index. You'll notice that in October of 2022, that sentiment was as negative as it was in 2008 during the financial crisis. It was as negative as it was during the depths of the decline when we shut down the market in 2020. So this was one of the reasons that we were talking about, hey, we're probably going to get a rally from here. I didn't know how far the rally would go. I really did not expect it to do what it did over the last 2 years, but we were so negative in sentiment that was really a good setup for a reversal rally. Because as you just said a second ago, when everybody kind of doesn't want to invest, it's generally when the market gets you. And that's where we were. Nobody really wanted to buy stocks. They were, worried about this continued decline. There was, lots of talk about recession and all these other things were going. Don't forget, Russia was invading Ukraine at the time. The Fed's hiking interest rates. So tons of reasons to expect the markets to go a lot lower. But we had wrung out so much sentiment at that point that was a setup for a decent reversal. And of course, since then, not only has the market reversed, but now so has sentiment. And sentiment's now getting back to levels that we saw, in kind of that late 2021, actually I should early 2021, which suggests that, we could certainly rally this market in the first half of next year. And that, pushes sentiment up further. Here, I'll give you kind of the background scenario. We get a Santa Claus rally that gets everybody excited. You get President Trump inaugurated on January the 20th. He immediately comes in, does some acts, extends the Tax Cuts and Jobs Act, which gives some stability to corporations. starts doing, working on some deregulation. Companies are going to like that. So that, and I'm just laying out an example. I'm not saying this is exactly what's going to happen. I'm just saying there's some things that could happen in that first kind of 100 days of his presidency that gives the market some more confidence, and it rallies until June, July, somewhere in there. And then we kind of hit that peak exuberance next year. And that's where we kind of drug all the last holdouts finally in. And then we get potentially get another correction towards the end of next year, or maybe in 2026. That's just a guess. Nobody knows. Predicting anything more than a month out is just ridiculous anyway. But
Right.
I'm just saying is that if we kind of look at 2021 as a measure, we've got a lot of that same sentiment set up that could drag this market higher for a while longer before you finally get that kind of capitulation of the bears.
Yeah, and I mean, just looking at your chart here, that wouldn't super surprise me to my point of like, it feels like there are less bears standing around at this point in time. Maybe, but on your chart there, you had years where the sentiment was even more bullish and had lasted for years. Right.
So, but it can last 6 to 8 months for sure, or even a year. Absolutely.
Yeah.
You can certainly get to higher levels, and we've certainly done it before, but that can happen very quickly too. I mean, you'll be amazed is that kind of when we hit that final excitement point, sentiment can go up very quickly. And so we'll see what happens. But, valuations are very stretched here on a forward basis. Earnings, as a good example, I'm writing an article right now for this weekend's newsletter talking about earnings sentiment. Right now, analysts expect S&P 500 earnings to grow by 19% next year. So from 2024 to 2025, earnings will grow by 19%. Mm-hmm. The historical long-term average of earnings growth is about 7%.
Yep.
So now, analysts are always wrong. And I'll give you a good example of this. In 2023, analysts expected S&P 500 earnings to grow by about 15% in 2024. The actual growth rate was 9%. And we've had a boomer year this year on 9% earnings growth. So that's why forward valuations are going up so rapidly, is because the price is outpacing even forward estimates, but those forward estimates are coming down. And we're going to see more of that next year. And the big concern ultimately is going to be when earnings fail to really keep up with kind of the fantasy. And if we start to see earnings really pull back, and we talked a little bit about this last week. I have an article on the website today. So if you go to Substack, you can get the article. It's on the Kaliki profit equation. I know it's really geeky and it's great to put you to sleep at night, but what it discusses specifically is the importance of the role of government spending, debt, and deficits on corporate profitability. So if Trump comes into office and drastically cuts government spending, you're going to have a reversal in corporate profitability. And that's going to make it very challenging for stock prices to rise next year.
Okay. I actually do want to talk about that Kaliki article because there's some good charts in there, but I got that a little bit further down in today's agenda. All right. So, we're at this point right now where euphoria is high. A number of the folks that I've been interviewing in this channel recently, Lance, have been saying, hey, look, yeah, the peak's probably not in yet. Things could probably get even a little bit more euphoric. But I would say the consensus of the folks I'm talking to right now is an expectation that, we'll hit some crazy zenith, and then there's going to be some froth taken out of this, and not necessarily, a 50% market correction, although some like Henrik Zeberg, who I interviewed a week ago, certainly think that could happen. But to your point, could be an 8 to 10% correction, right?
But let's talk about a 50% correction real quick, right? So in 2020, we had a 35% correction in the market, right? Now that's pretty dramatic. So a 35% correction took us back to, and I can show you a chart of this, but all it did was pull you back to the running trend line from the 2009 lows. So the bull market was never violated. So it was a correction, even though it was 35%, and outside the normal definition of 20% decline is the bear market, it never got you back to breaking that long-term bullish trend. So actually, Mike and I were just talking about this morning, exactly this exact point, because there was an article that got put out talking about 50% correct. Be ready for the 50% correction. It's all going to be over. A 50% correction from here would take you back to about 3,100 on the index. which is about where we were in 2020. So in other words, a 50% correction from here, while it sounds enormous, doesn't even break the long-term bullish trend line from the 2009 lows. But that's how deviated the markets are. Is that just this would be this is going to be the hard pill for people to swallow. A 50% correction from here is a normal correction in the markets, because all it did was reverse the excesses back to the bullish trend, which is what the market does repeatedly throughout history.
Yeah. So I think people are a lot of the watchers of this channel totally get that. Like we talk an awful lot, you and I, as well as the other guests, about the extreme level of valuations that the market has relative to historic norms. And I guess people have two concerns. One is, okay, like systems mean revert, right? And I don't want to be on the wrong end of a mean reversion, right? Even just getting down back to the trend, right? And then people will also
wait, real quick. I'm not saying that you write down a 50% correction. I'm not saying that at all. I'm just trying to put it in context, because when you talk about 50% correction, everybody's going, oh, financial crisis, the world's over. In this environment, because of the extensions, it would be a normal market correction. It wouldn't even literally, from a technical point, be considered a bear market.
Right, which is going to my next question, which is, okay, so if they're like, look, if you're asking me to be long this market and trade this market, there's just my normal mean reversion risk, which is losing half my money,
right?
Or that a true bear market shows up. And what do I lose then?
Yeah.
75%, 80, right?
And that's possible.
It is possible, right? So I just want to give voice to this, because I think it's probably something that the average viewer of this channel just carries with them on a daily basis, right? And this is your whole thing about trading the markets we have versus the markets we think we should have, or whatever, right? Which is like, I think to that type of person, and maybe this is knowing just enough to be unhelpful and dangerous, right? to your long-term wealth building prospects, is if I understand these risks, being majority long the market kind of has a feel of like walking a really high tightrope without a safety net, right? It just doesn't feel good, right? But then again, if you just say, well, look, then I'm just going to stay on the ground and not climb up to the tightrope, well, okay, then it's like, kiss the purchasing power of your wealth goodbye, as it just sits there and gets eroded by inflation, right?
That's right. Well, but again, these are the things that, and this is why we talk about risk management and all these type of things, because these events, and again, do not get me wrong, right? I have never in my life had to sit down with a client and go, yeah, the market is down 50% this year. This is how we're going to get your money back, right? And just, you don't have to do that, right? You can manage and navigate risk, and in drawdowns, you're going to lose money, right? But you can certainly mitigate that risk of loss to a large degree. And no, you're not going to time the top of the market. No, you're not going to buy the bottom of the market. You're going to miss out on some of the early gains in the market, but that's okay, because our goal is just to grow money over time. And if we can mitigate those risks of downturns, then I don't have to spend as much time getting back to even to start making money again. And that's the thing that passive index investors forget. And they think, well, the market it just seems to go up over time. So if I just buy an index and ride it up and down, that's awesome. But small and mid cap stocks are a great example. S&P 500 has been making 50 new highs this year. IWM, the Russell 2000, is basically trading where it was 3 years ago. So you've made no money in 3 years if you were buying and holding on a passive index. Buying and holding IWM, you've made no money, versus buying the S&P, you've made money. So, this is why asset selection is important. This is why when you talk about diversification, you actually understand what diversification means. And that doesn't mean just buying a bunch of assets and sticking them in there and kind of crossing your fingers. This is the important part about risk management, understanding where your risks are, how much risk you're taking, and what that expected return is supposed to be for that risk. Because the risk is not how much money you make, it's how much money you lose if your thesis is wrong.
Mm-hmm. All right, so couldn't agree more. And again, this is really the main reason why I have you and other financial advisors on this channel, and recommend that most people work with a good financial advisor who thinks like you guys do, takes all these macro issues into account. Because if you're just out there kind of hacking your way through the jungle of investing as a regular investor, and you don't have a deep experience base and the knowledge that folks like you do, Lance, and aren't intentionally deploying these time-honored, wealth creation and protection behaviors, diversification, rebalancing, active management, all that type of stuff, then you're just highly likely going to be vulnerable to these vagaries, right? So anyways, I did just want to put my finger on that, because when I talk to people, in the real world, that is the biggest lament I hear from them, which is, I know I have to be invested to grow my wealth, but at these, this crazy upward deformed, market valuations, I just feel like, at any moment the floor could drop out from under me. And I think most people watching this would love a 50% market correction to happen, because they would feel so much better about deploying capital after that and say, look, I'll be a happy long after that.
No, but see, that's the fallacy of it. And there's actual proof that that's wrong. Because in 2008, a great example of this, and this is a real-time personal example, and I've talked about this on the show before with you, but just a great reminder of that. I learned a real valuable lesson in 2008. So in early 2008, probably around June, July, we sold out of all of our equities and we just bought treasuries. So we missed the whole downturn in the market. It was fine. In February of 2009, I wrote an article called 8 Reasons for a Bull Market, and we started buying equities. I lost almost $100 million worth of assets over the next couple of weeks, because people were like, are you crazy? This market's you're apparently not aware. This market's going to zero. This is akin to the Depression. All the banks are going to fail. Lehman was just the start. And of course, that was the bottom of the market. And since then, the market's up 600%, and the rest is history. But see, this is always the fallacy of investors, which is, oh yeah, I would love to get a 50% correction. That would be awesome. Well, what they don't realize is that if you're getting a 50% correction, you probably just lost your job, because the economy is now in a deep recession, and you are having some type of financial credit event, and you've probably lost your source of income. And not only have you lost your source of income, you've been watching your portfolio decline sharply. So now the question becomes, what do? What most people do is they go into immediate defense mode. They sell everything they have at the bottom. They go into alternate protection, and then they don't come back to the market for 5, 6, 7, 8 years.
Yeah, certainly can happen.
And we know that, Adam, because you and I have had these conversations about people showing up last year going, well, I've been out of the market since 2008. I think it's time to get in.
Right. No, and that goes back to the job of a bear market, right? It's just to make everybody hate, financial instruments. I guess my point was more, because that's very true. And of course, that's, again, what a good advisor will do is hopefully keep you from the worst of your emotions. But I think a lot of people here would say, look, I can look at a historic chart and see, okay, today's CAPE ratio of 36 times, is very elevated. I feel a lot better buying in at a 13 times CAPE PE.
You'll never see 13 CAPE again in your life.
Probably not, but just doing the 50% math.
Right. No, I get that, right? I mean, that's simple math, right? We'll never see that again. And because the one thing we're not talking about here is the important elephant in the room. If there was ever an event that should have caused a 50 to 80% market correction, that would have been March of 2020. You shut down. Now think about it for a moment, right? We had shut down the entire economy.
You just turned off the GDP spigot, yeah.
You had a 35% decline in the economy, worse since the Depression. Nobody can work. You can't go anywhere. You can't buy anything. Now, if there was ever a catalyst, and of course, earnings got destroyed for corporations at that moment, right? So if there was ever a reason, and I'm saying to this now for all these people saying there's going to be a 50% correction or more and everybody's going to get wiped out on their wealth, if there was ever a reason that would have happened, it would have been in 2020, more so than even in 2008, because you shut down, in 2008, we just had the credit market freeze up because of Lehman. We shut down the whole economy. Nobody's making any money.
Right.
So that was the reason right there. You should have clipped 50% off this market, at least, if not 70 or 80. We had a 35% correction. Why? Because immediately the Fed jumps in, $120 billion a month, with rates to zero, and we start just flooding the system with liquidity. So you can guarantee that if this market declines 30, 40%, so just, and if we just go, okay, I'm just looking at a chart right now. I'll just share it with you. I'm just playing with some numbers while we're talking. This is a chart of the S&P. And so if we just run this market back down to somewhere around this running trend line, kind of along these lows of the market going back to 2009, that's going to be about 25% off the market where it is currently. Just give or take, it's called 25 to 30, somewhere in there, depending on where we break from. The Federal Reserve is going to step in, because at that point, you are now starting to risk economic growth. You're going to have a collapse in inflation. You're going to have super negative sentiment across the economy. CEO confidence will drop. CFO confidence will drop. You're going to start experiencing issues in the financial system of liquidity, the kind of liquidity flows within the market. So you can almost bet that at that level, depending on how fast it happens, if it's a gradual decline like we saw in time of 2022, maybe not. But if it's a rapid decline, something breaks, you're going to see the Fed step in. So you're probably going to cap your downside of some market correction to between 30-35% before the Fed acts aggressively.
Yeah. Okay. The good reminder. It's a very reflexive system.
Right. And that's why PE ratios will never go to 13. We may get PE ratios down to 15 to 17, which has now been kind of the long-term bottom of this century. We may get a reversion back to those levels. That'll probably be where you start buying equities.
Okay. All right. Well, look, I got to get back on the schedule here because we got some more stuff to dig into. But on kind of rounding out, well, first off, we mentioned that you had just published an article on euphoria and leverage and speculations being at extremes. Are there any other elements of that report we haven't talked about yet?
Not really. Where we're seeing it is obviously in record levels of ETF volume in 2x leveraged ETFs. We're seeing record volumes of issuance in single stock ETFs, seeing record, options trading. That's where all that exuberance is showing up. So if you just kind of go through the market and look for where people are taking on the more risk, on the most risk, it's becoming quite evident that, and again, this isn't, moderate surges. We're talking about straight up spikes in the amount of flows into leveraged ETFs. And we saw this previously. And back then, if you look at the data back then, it was like, man, it was like a huge spike. And then now you look at the spike today versus then, you can barely see it. It's like a little bump, right? It's just gone to an extreme. And unfortunately, this is a lot of retail traders, a lot of retail speculators. And look, it's all over Twitter. It's all over, any social media. Bitcoin's going to 1 million, and this is going to the moon over here, and rocket ships on this over here. And this time is different because of A, B, or C. And this is exactly what we're saying back in 2021. It was the same. We were writing the same exact articles back then, talking about speculation. Something will happen, and when it reverses that asset flow for whatever reason, you're going to have a big correction.
Okay, and I did note here that Bitcoin did briefly cross $100,000 a coin. It's a bit below that the day we're talking here, but just want to confirm with you. I assume you think the recent run that's been heading Bitcoin is largely a factor of this speculation as well.
Well, it is. Bitcoin is if you look at Bitcoin as a, kind of a corollary asset, right, of risk, it's, stocks go up, Bitcoin goes up. And if the stock market corrected by 10% tomorrow, Bitcoin will be down 20% because they're very correlated historically over time because it's a risk-taking asset. So if investors want to take risk, what do they buy? They buy assets that have the most volatility. So I buy stocks, I buy Bitcoin, which has about 5 times the volatility of the S&P, if not more. I buy those types of assets. If I'm
you buy MicroStrategy, which basically has become like a one stock ETF on Bitcoin, right?
It is. It's a leverage bet on Bitcoin, and look, and this has nothing to do with the thesis of Bitcoin. You can have all your theses about why Bitcoin's different, and why it's going to replace the U.S. dollar, whatever it is. That has nothing to do with the speculative trading that's going on in the system right now. You have a big demand of buyers, and nobody wants to sell it because everybody thinks it's going to keep going up, right? And so that's the beauty of market dynamics is that as long as nobody sells, Tom Lee was doing a analysis on Bitcoin and MicroStrategy's use of convertible debt to buy Bitcoin. He says, and so everybody was like retweeting this this video, and it's like, see, this is why Bitcoin's going to go to 1 million, because they're using convertible debt to do this. But everybody kind of missed the one line that Tom Lee put in there, which was, as long as the price goes up, this is genius.
Yeah.
Right. And look, I'm not saying that Bitcoin, so don't start emailing me that Bitcoin's going to go to 1 million and whatever. I'm not saying that at all. All I'm saying is that, if there is a correction in risk assets, all risk assets will correct, because they are all correlated now to a very high degree.
Right. And the more speculative risk assets will likely correct the most, right?
Look, you can measure corrections by volatility, right? So if you have we can just use simple math, right? So, and this is very basic, but basically, if I have an asset that has a volatility of 1, if the market goes down 10, it'll go down 10. If I have something has a volatility of 5, if the market goes down 10, it's going to go down 50 in theory, right? No, that's not actually going to happen that way. But the more volatility that you take on, the bigger the gains. And see, and this is always the trade-off, right? If I buy a high volatility asset like Bitcoin, it's going to go up a lot. It's also going to correct a lot. And last good example, in the last correction, the stock went down about 50. Bitcoin went down about 50% before this recent rally. That's a big correction. So if you're worried about a 50% correction in the market, it is more likely to happen in Bitcoin than it is the actual stock market, solely based on volatility.
Got it. Yep. And this is, I think why these speculative periods that we're in right now can be so unfortunate for less experienced investors, because especially in the crypto space, not just Bitcoin, but there's all these other cryptos as well. We talked about the Haktua coin. But it's moments like this where people, pardon me?
I'd say, by the way, the Haktua coin is a great example of speculative frenzy, because see, right now, I can come out with the stupid coin and people will buy it, because they're just like, oh, all Bitcoins are going to go up. No, all Bitcoins are not going to go up. And just because I issue a cryptocurrency, I shouldn't say Bitcoin because that's wrong. Just because I issue a cryptocurrency of some sort doesn't mean it's a good investment, aka the Haktua coin. But in a speculative frenzy, that'll go up because everybody's willing to buy everything, because everything is going to go up at the same time. That's the theory.
Right, and that's actually, you're making my point here for me, which is it gets the person who's sort of been either reluctant or mildly curious to start doubting themselves and saying, you know what, my friend here is making a killing on his stupid coin, whatever, right? Like, all right, I got to get in here, right? And I've certainly seen this around me, certainly with Bitcoin making the run for 100K. People, including my wife, have said, oh, I've been hearing my friends who've been buying this, and why we should we have more of this, right? And if it indeed is a speculative spike, like it very much seems like we're having right now, again, that job is to suck all those late stage people in. And these are the people generally at the 8th stage, like you said, they're retail investors. They tend to not be as sophisticated as dyed in the wool investors. They come in with capital they really can't afford to lose. They've been sold, they've got dollar signs in their eyes because apparently this is a can't lose investment, right? And then all of a sudden the speculative spike is over, and they're sitting in these high multiple volatility assets, and market goes down 10 and they lose half, and they're like, what the hell just happened to me, right?
Exactly. Well, it was funny because I put out a tweet the other day, right before the election. I bought some Ripple in my crypto account, and I didn't even pay attention to it. And I looked at it the other day, and it's gone up like 300%. And so I put out on X, I said, I bought some Ripple before the election. What do I do with it now? And the comments were absolutely hysterical. They were all over the board, from you need to sell it and run away to buy more and it's going to the moon, right? But it was actually fascinating because, it just showed the sentiment break on what's going on. And by far, it was like one of my most viewed tweets. What do you call an X post now? You just call it a post?
You literally call it an X post. Yeah.
You just call it a tweet. Anyway, I'm old. It's a tweet. But yeah, it was just so funny because you could watch the psychology about the crypto market just unfold and all the comments that came off this
Yep.
one kind of tweet. And so, I'm learning to love X as a sentiment indicator. I'm going to try to figure out how to turn it into something.
Yeah, I'm sure there are people, I'm sure there are organizations out there that have, algos that measure sentiment. I mean, honestly, I'm absolutely certain that quants on Wall Street have that nailed already.
Yeah, they do absolutely, and they use it for individual stock sentiment. So when you put in $ Apple whatever, and you're talking about it, yeah, there's algorithms that are watching that. And if there's a whole bunch of people talking about buying Apple, they'll go buy Apple. If a whole bunch of people talking about selling Apple, they'll sell Apple. So, but yeah, that sentiment plays a big role. But I'm thinking more of it just from if I can do maybe a series of polls or something during the week, and then convert that data into a chart that we can share on the weekend, and maybe we can try this.
Sure. I mean, I've done this. I've already done this on Twitter a fair amount. Now, of course, the thing everybody will shout in your ear, which is the obvious, which is this is not a representative sample of, American investors. It's a representative sample of the people that follow or read your posts, right? But I still think it's super instructive. So go with it. Yeah. So I'm glad you mentioned Ripple, because I was going to mention that. I saw your tweet. And I don't know all the reasons why Ripple has gone up. I know that Ripple, and it's old knowledge, but I think they were really trying to become like the coin or the token that is like built by the banking system for the banking system. And so there's some advantage that they're trying to get through that. If you know anything about Ripple, you can probably tell I don't, by my hesitancy here. The only thing that I thought was interesting in mentioning here is the CEO of Ripple is Brad Garlinghouse, who I worked with at Yahoo back in the day. And yeah, what's interesting is, so when I saw the spike, I was like, maybe I should have Brad come on the channel here. So first off, folks, if you're viewing this and you have a strong opinion one way or the other, let me know in the comments section. If there's enough people that want me to reach out to Brad, I will. Can't guarantee that he'll agree to come on the channel. He's gone on to way bigger and better things from when I last knew him. But if he'd be willing to, it could be really interesting insight from a real insider there. I did happen though to pull up, how many Ripple coins does Brad Garlinghouse own? And there's all sorts of different estimates. But what's so interesting is when we worked at Yahoo, it was back in the day where there were fewer billionaires than there are now, and two of them ran Yahoo, right? David Filo and Jerry Yang. I'm pretty sure that Brad Garlinghouse now has a lot more billions than Dave Filo and Jerry Yang, thanks to Ripple.
Probably.
Yeah. All right. Well, look, one thing we haven't talked about yet today was this morning's big news, Lance, which is the November payrolls report.
Yeah.
And I'd love to get your thoughts on this one because it's kind of interesting. The report beat expectations, right? They came in at, I think, 227,000 versus expectations of 220. Very uncharacteristically, we got some revisions of prior months, but these were upwards revisions rather than downward revisions, right? Wages also grew a little bit faster than expected month over month, 0.4% versus 0.3%. So in one sense, this raises questions of like, hey, these aren't cutting conditions, right? For the Federal Reserve, we're seeing wage inflation being a little sticky, jobs market's looking fine, right? All that type of stuff. So, on one hand, it would sort of make people say, well, is this going to slow down the Fed's, rate cutting schedule? Does it make it harder for the Fed to cut? But the unemployment rate rose from 4.1 to 4.2%. Again, not a hair on fire development, but still. I also want to note too, that consistent with what we've seen in the past, the BLS's two different surveys tell very different stories here. The establishment survey is the one that reported the 227,000 gain in November. The household survey, though, indicated much bigger weakness, with the number of people employed tumbling by 355,000 for the month. So, I was actually talking to Lacey Hunt yesterday, and he is, quite concerned about where the labor data is going. And he noted that ADP earlier in the week came out with its own data. They revised their increase in October downwards, and this was the largest downward revision they've made to the data since May of last year. And the reason for making the downward revision was they were citing that June QCEW report, which has a lot more data points than the BLS surveys do. Which, that's the most recent QECW report, and it basically said, hey, we're losing even more jobs than we thought back in Q1. So Lacey thinks that the BLS models are continuing to ignore the June QECW data that came out, and that as a result, there's going to be another big downward revision at some point in the not too distant future, just like we saw the $800,000 jobs revision earlier this year. So yeah, so when I asked him in this conversation yesterday, and of course this was before today's payroll numbers came out, I said, look, Lacey, like when, to your estimation, like when is this not going to be people digging in the report and saying, oh, I've got a different point of view than what the headline says? When, if you think the weakness is as bad as it is, when's it going to be apparent to everybody? When is it not going to be a debate? And he said probably in February or March of this coming year. So anyways, a lot of dust continues to still be in the air around the jobs market here. Of course, the stock market, all they really kind of care about are the headline numbers. They are what they are. What are your thoughts here, Lance?
Well, so first of all, don't put a whole lot of weight on this particular number because it's still all messed up by the hurricane, the two hurricanes, what happened in North Carolina and Florida. They had the Boeing strike. So this is the report just post that event. So everybody that was out of work got laid off. They came back to work, that type of thing. The strike was over. They've come back to work. They got a pay raise, that type of thing, right? So, there's a lot of anomalies potentially in this data. So I wouldn't put a lot of weight on it. But the statements you made, though, about this really isn't data for Fed rate cutting, none of the data, the Fed has had no reason to cut rates at all this year. From economic growth to inflation to, what's going on, in the markets, there's been no reason to cut rates. And they're cutting rates and trying to get an anticipation of, potentially what's going to happen next year. But the Fed rates level is very restrictive relative to where we are in the economy. So they're trying to get that back down to a more unrestrictive level. And that's also what's kind of been fueling some of the other stuff going on in the markets. But to your point, there's been no reason to cut. Everything's doing fine. And like I said this before, I said this going into the first rate cut back in September. I said, there's really no reason to cut rates. I thought they would cut by 25 and then they did 50, right? There was absolutely no reason to cut rates 50 basis points in September. No reason. Right. But they did anyway, and so here we are. They'll cut rates next week, another 25 basis points. Maybe they'll pause at the first meeting in February. We'll see what happens. But yeah, there's, what's going on is that they're trying to get ahead of this softening of the data. I think they see, kind of underneath the covers of this. And if we look at a lot of the data that, we kind of follow with and pay attention to most, we're seeing that slowdown in employment activity. We're seeing full-time employment continuing to decline. Full-time employment on a year-over-year basis is negative. So we're not, and importantly, full-time employment is what supports economic growth, because if I have a full-time job, it pays better than part-time work, obviously, has benefits, part-time work doesn't. So healthcare, insurance, those type of things. That's what supports families. And if that is running negative, then that is not really supportive of economic growth at 2.5% or 3%. So I think the Fed is aware that economic growth is going to continue to slow next year. They're hoping they get a little bit ahead of that and potentially soften that blow a bit as we get to 2025.
Okay. And to your point about full-time employment being negative, that's with a lot of government hiring.
Yes.
Right. And in this change of administration, hard to expect that government hiring is going to be anywhere near as high as it's been, given the whole focus on DOGE and government efficiency and cutting government bureaucracy, correct?
Right. Yeah, and we talked a little about that. That's going to be I think that's going to be a tough challenge for the administration. They want to get rid of a lot of government agencies, bureaucracy, employment. But the Civil Service Act, I think it was 1978, enshrined a lot of those jobs. So it's more difficult to fire individuals than you think. And it was a fascinating stat yesterday. Outside of, if you include maintenance and service people for the government, only about 6% of people actually show up to work for 40 hours a week in an office. If you
6%.
Yeah, but wait, listen to this. If you subtract out the maintenance and service people that have to be at the office to make sure the building's running, 1%.
Are you kidding me?
1% of people in government show up for 40 hours a week.
That's just mind blowing. Is that really true?
I do not have the data to back that up, but I was listening to an economist that was talking about this the other day, and that's his stat. But if it's true, it's pretty phenomenal.
Yeah. Wow. So I was talking with Brent Johnson yesterday, and folks, that video is going to come out the day after this one. So if you're watching this the day it launches Saturday, Brent's going to come out tomorrow on Sunday. And we talked a fair amount about what to expect from on the deficit spending side. And granted, neither Brent nor I are political economists, so take all this with a huge grain of salt. But the question I asked Brent was, okay, so do you expect Trump to have materially lower deficit spending than the Biden administration? And Brent had a hard time imagining that. You mentioned a little while ago, Lance, that if we do, that will then definitely create some issues in the economy and the markets, because all that great liquidity, the corporate profits specifically, you thought would be coming down. And we're still getting to your Kalecki profit article in a second here.
On this show, that's what we need to do.
Yeah. But I asked Brent, I said, okay, so if you don't expect Trump to spend, markedly less, is Doge then, and this talk about making government more efficient, is it then more of a redistributive process or redirection process than it is a curtailment of spending? Meaning they'd say, look, government spending might still stay in the same ballpark, but we're going to direct it away from things that we think aren't creating value and direct it to things that are more strategically important, and will make, help us get better bang for the buck for the dollars that we are spending. Do you have an opinion on that?
So that's the part I'm wrestling with entirely. So I've got to do, you're going to be here for our economic summit in January. Then I've got to fly to Canada in February for the Money Outlook show there to talk about this as well. But I'm trying to put together this whole outlook for 2025, and the problem is the whole idea about deficit and debt spending, right? Is he going to be able to cut the spending, or is it going to require more spending? And the one area that you can I think he's going to have a very tough time cutting government for a whole variety of reasons.
Sure. Everybody will scream. The entire system will be fighting him. Yeah.
Not only that, though, he doesn't. Yes, we have control. He has. Let me rephrase that. He has control of the House and the Senate, right? Which makes, in theory, the ability to pass things through much easier. The problem is that a lot of the conservatives, quote unquote, they're not really all that conservative, and they're beholden to their lobby groups, et cetera. And all it takes is 3, 4, 5 of these guys to basically kind of defect to the other side and vote against some of his bills. So, the one area that he has the ability to cut the most spending on is to work with Scott Bessent over at the Treasury and Jerome Powell at the Federal Reserve and get interest rates down. You could cut $500 billion a year off spending just by getting interest rates down, because that's the interest service on the debt. I think really probably his only real option for getting government spending down markedly to where he can claim victory. I'm not saying he can't do the other stuff. He's going to institute Schedule F to reclassify government positions to make them fireable. He can certainly move agencies out of Washington, D.C. and move them to like Billings, Montana, somewhere like that. That's certainly possible. And again, I don't know his plans. So, don't argue with me on the internet, because I don't know what his plans are, but I'm trying to figure this out, because that's going to be very key to what happens in the markets next year.
Yeah, yeah. One other thing just to put into your calculations is I've been reading recently about this concept. I think it's called impoundment, which is where basically Congress will approve funds, or there are already pre-approved funds to be spent, and the executive branch just says, "Ah, great, they're approved. I'm not going to spend them though." So again, is that something he's willing to do? Is that part of the plan? Again, that would take,
Oh, there's
some of the
yeah,
joy out, and you get a lot of blowback for it. But that is one thing that's fully in his control, right? Is
that,
okay, you put a pile of cash in my bank account to spend, but I'm not going to spend it. Yeah.
right. Real quick, back to employment. I was just while you were talking, I was running some quick numbers. This is, yes, the employment number was really good today, but this is full-time versus part-time employment, and part-time employment is declining, full-time employment is declining. So, while the numbers look good on the surface, what's actually happening underneath the surface is a weakening trend in the data, and I think that's
Right.
that's the important thing we need to pay attention to.
Great. But just to be super clear, cumulative full-time employment is declining. Part-time employment is growing less slowly.
But yeah, correct. Thank you for correcting that. Yes, I don't. It's the rate of growth is declining.
Yeah, yeah.
Yeah.
And of course, having positive part-time jobs and negative full-time jobs is generally a sign, I think, of a weak economy where, as we understand from the data we have access to, it's because people are having to take on additional jobs to try to make ends meet, right? Yeah.
And I mentioned earlier the year-over-year change in full-time employment. There it is. We're negative 1% on a year-over-year basis. That's actually declined over the last 3 months. So even though we had a big jump in employment in November, it's been falling for the last 3 months in particular.
Yeah.
So,
And again, this is with aggressive government hiring, even being below the red line there. So, if Trump is true to his word that like, hey, even forgetting about firing people, we're just not going to hire nearly as much going forward. Presumably that number will get worse unless there's some recovery in the private sector.
right. And the thing about this is to note is that when you have negative full-time employment, it has always aligned with recessions. And that's really, and again, going back to why is the Fed cutting rates when really the economic data says they shouldn't? I think that's why.
Could be. I mean, that's the whole Kantrowitz, so goes the employment, so goes the economy, right? So yeah, we got to watch it super closely. All right, look, got to start wrapping up here. We'll get to your thoughts on what's going on with the markets. We'll pull up the charts. We'll talk about your recent trades. Real quick, do you want to show any of the charts from your collect profit equation? Is that what we're talking about here?
Yeah, sure. I mean, because it kind of goes right into what we're talking about, just from the
Right.
standpoint of look, everybody's very bullish right now. Whether it's whether it's sentiment indicators, whether it's the NFIB small business report, consumer confidence, those are all going to show sharp increases. Everybody's optimistic about the election and what it means for next year. Because what are they hoping for? They're hoping for deregulation. They are basically promised at this point that the Tax Cut and Jobs Act from 2017 will get extended, which means that corporate tax rates will not go above 21%. So they got that in the bank. So a favorable tax structure will remain in place. They're hoping for a further cut and maybe get that from 21 down to 15%. So businesses are very optimistic about that. But less regulation, less taxes. That's very good for businesses, and so they're very jazzed up about that going into next year. Now, whether or not any of this comes to fruition is going to be a different story. But the Kaliki profit equation, and again, this is great bedtime reading. It'll put you right to sleep, guaranteed. But what this discusses is the impact of government debt and deficit. So one of the things that Trump's talking about through whether Doji or whatever it is we're going to cut spending, we're going to reduce the debt, we're going to reduce the deficits. And that's what everybody wants, right? And I'm not saying that's not a bad thing, but just like, getting fat, you can't just get skinny, right? There's stuff has to happen in between that isn't necessarily all that fun, right? You got to diet, you got to exercise, whatever it is. And that certainly takes a lot of work and effort. It's not enjoyable in a lot of cases, but it'll eventually get you to your goal, which is good, right? So you got to experience that pain in the middle. And we talked about this before, Adam, is that one of the biggest challenges for the Trump administration is going to be communication. And if I was President Trump, I would walk into office on January the 21st and say, ladies and gentlemen, thank you so much for electing me. I'm going to crash the stock market. So I just want you to be ready. I go take all my money out of the market for about 6 months.
Which would cause the stock market crash, but yes, okay.
Stock market to crash, but if he did that, and I'm exaggerating here a bit, but just follow the logic for a second. If he did that, then he immediately goes into cutting government spending, all that he wants to do, right? I mean, get super aggressive about it, reduce the debt, reduce the deficit, which is going to impact the market anyway. Then you get the recovery. And the problem that he may run, but he's very tied to the market. He measures his success by the value of the stock market. So we expect the stock market to keep going up, even while he's causing this underlying structure that I'll explain to you in just a second, that could impair that. So by not communicating extremely upfront that, hey, these actions may have consequences, he runs the risk of basically, having a market go down while he's doing these things, and it starts kind of impairing his favorability ratings and those type of things. So that's what I'm saying. If I was him on day one, I'd say, I'm going to do these things. You need to be aware that this is going to impact the markets, most likely short term. We could have a recession because of this, but it's necessary to get this country back to where we need to be financially and economically. And I think Americans would buy into that, because they understand it. They understand that getting out of debt requires some pain and requires some discipline. They understand that doing something to make things better is going to require a challenge in the middle of that. And so that's what I'm saying is it's going to be very important for him to communicate effectively and let people know what that risk may be. And here, let me explain to you why. So this first chart.
Just real quick, I just want to say, so I've been saying this loudly for the past week or two on this channel. As you know, we talked a bit about it last week. So I agree with everything you're saying, which is, look, I think Trump should be communicating this. I think it's going to be a big error if he doesn't. And he should just say, look, yeah, folks, this was so much worse than I thought it was. Now that I'm coming in and getting a fresh look at everything, boy, you're glad to have me. We're going to have a phenomenal economy and stock market once this is all cleaned up. Yep. But we got to go through the hard stuff and, make it a national call to unity that we got to tighten our belts together, but we're getting to a better place, right? And he's going to, he's got to get all the painful stuff started early so that while he still has the goodwill and people haven't gotten tired of the bad stuff, that he's knocking all that out, right? The one thing that
I think people would buy into that. I think people in general understand. I mean, you just know by all the comments that you get about the debts, the deficits. We're going to be Japan, whether it's Paul Tudor Jones or Stanley Druckenmiller, the world's going to end because of the debt and deficits. I think you could get a lot of buy-in. We did this back in World War II. We got America to buy into World War II.
But this is where I was going though. So yes, I agree. Although I think, to pull a World War II phrase from Churchill, Americans will do the right thing after they've exhausted everything else. We're not the same culture we were in World War II. We don't have a living memory of shared sacrifice much, right? Really since probably 9/11, right? And so I think it's going to be rough. I think it's going to take effort and pain to get people on the train, which is why you should be starting now, right? Because I think a lot of people will fight this because it's either I didn't vote for Trump and he's creating all these issues, or it's just Americans want the easy button, right? Just give me the pill, all right? I want to lose weight, so put me on Ozempic. Don't make me diet and exercise, right? So I think I think we'll do it, but it's got to be a conscious effort and outreach. And so far, I'm not seeing it. So far, it's still just people are like, yeah, we elected him and he promised a big, beautiful economy, and we expect that from day one.
Right. Yeah, and I think that's the risk, right? But but here's the risk, right? So let me explain why I think it's a risk. This is corporate profits as a percentage of GDP, which have never been as high as they are now. Notice where corporate profits and GDP took off, right? Post 2020. So you had zero interest rates, all trillions of dollars worth of government spending coming into
PPP loans. I mean, just money, money, money. Yeah.
Absolutely. And so that creates stock prices to go up, but corporate profits, which means that companies were able to sell products and services at higher rates. People were willing to pay more for it because the government was giving them money. So they're like, okay, you're gonna give me $3,000 extra a month for childcare? Great. What happened to childcare prices? They went straight up, right?
And you may remember I pulled up a similar chart months ago and asked you the question, did corporate America basically just stick the consumer with all the pain of COVID?
Basically, and not really stick it to them. I mean, it's just basic business. If I know that you have more money to spend and you're demanding my product, I'm going to charge you more money. That's capitalism, right? Why should I set, there's sticking a price control on me saying, okay, my widget normally costs $1 and now everybody wants my widget. So Adam, you come to me and say, okay, I want your widget, but I only want to pay $1. I'm like, why would I sell it to you for $1? I got 10 people over here that want it for $5, right? That's capitalism. That's business. So yes, when you give people money they did not earn, and then they all want to go out and buy product that is not available, prices are going to go up, and that improves corporate profitability. And so that's what happened.
Yeah, absolutely. But just underscore, corporations got the higher profits and the higher stock prices.
At the same time,
the vast majority of Americans who don't own a ton of financial assets got the higher prices, and once the checks stopped, right, they're stuck with the long term.
Yeah. But that's going to correct. So the Kaliki profit equation is very simple to understand. Here, let me back this up just a second so you can see it. So this is the equation: profits equal investment minus household savings minus foreign saving minus government saving plus dividends. So if profits are going up, then that means governments and households and foreign corporations aren't saving, right? They're dissaving. And this is one of the key points of this. And you take a look at household savings as a percentage of GDP, that's declining. It's bounced here just recently over the last, kind of year of last 6 months last year. But it's declining and it's in its long-term downtrend. So as households dissave, and again, we just saw that big negative revision to household savings wiped out like $140 billion. Mm-hmm. That is feeding into corporate profitability. If we look at, this is real profit margins as a percentage of GDP versus the deficit. And what you'll notice is that ever since we started increasing the deficit, corporate profits have been rising because the government is dissaving. So the less money they save, and you'll notice that when we had the one momentary point here where Bill Clinton basically took $2 trillion out of Social Security to balance the budget for about 37 seconds, you had a big drop in corporate profitability because the government actually saved money.
Was saving briefly, yeah.
Right. So this is kind of the key structure. So this is when we start talking about, the current issue of what's happening with debt and with valuations. There's a very high correlation between valuations and government debt. So the more the government spends, the higher valuations are because investors are willing to pay more for corporate profitability because corporate profitability is going up. So this is the big risk. Right. So as with President Trump coming into office and the Department of Government Efficiency and all Schedule F and all these other things, if we're really talking about slashing government spending and really getting, the government back under control, valuations and profitability are going to correct. Now, the magnitude of that correction, I have no idea, but it is going to be imperative to understand that the valuations that you're paying today for corporate profits as a percentage of GDP will be vastly different in an environment where the government's actually trying to save money.
Got it. And that has implications for investors, right? That would bring down PEs, right? But has implications for companies, obviously. And people might say, well, look, why do I really care about these, rich corporate fat cats that have been, milking the system recently?
Mhm.
And the sad answer to that is because, well, as those corporate profits come down, they've got to cut costs somewhere, and it's going to be, part of the casualties are going to be the labor force. There's going to be
Right.
layoffs, right?
And that's this chart here, which is margin adjusted CAPE valuations versus just regular valuations. So, valuations right now, if you just look at Schiller's CAPE, is around 35 times earnings. But if you start looking at margin adjusted CAPE, and this is all a function of that government spending, and you'll notice that margin adjusted CAPE really separated from valuations following 2008 when we did $47 trillion worth of government interventions. That's all a function of that government dissaving. So again, you've got a 50 times valuation in markets on a margin adjusted basis because of all this government excess. So again, so here's my point about this is that, if you're rooting for a big reversion in debt and deficits, understand the consequences.
Yeah, this is the cost of it. The cost of it is you got to go through these lean times. Yeah, exactly. Okay, so the important point, and also another important point too, is this is one of the things that if we are taking the administration at its word right now in terms of what its priorities are for next year, this could be one of those things, the harsh medicine that may actually cause some disruption both in the economy, the labor force, and the markets early on in a Trump administration.
Yep. And again, there's more charts to that. So again, if you go over Substack, Lance Roberts on Substack, you can get the whole article and kind of read. There's explanations about why all this works and the way it works in there, so you can get a little bit better understanding. It's hard to kind of go through it. Like I said, it's a sleeper article, but it's good to understand because there will be a cause or a repercussion of trying to reduce debts and deficits.
Right.
So,
well, basically, so goes the math of that equation. So will largely go the markets, right? So if deficits go up, well, expect corporate profits to go up, right?
Yep.
All right. So speaking of charts, can you pull up the S&P and just give us a sense of what the technicals are telling us right now?
Absolutely. So this is going to be a two-part conversation here, real quick. So this is the S&P. Everything's fine. Triggered the MACD. After we had that correction back to the 20-day moving average, we triggered a sell signal. And we said, hey, be careful. You got a little bit of sell signal here. So we're going to be looking for support around the 20-day moving average. Could be the 50, but it turned out to be the 20. We held that for several days, have bounced off of that. We talked about, last week and the week before that going into Thanksgiving, the week of Thanksgiving, the week post Thanksgiving tend to be pretty good weeks for the markets. That's exactly the way it turned out. Starting next week, for the next 2 weeks, we have mutual fund distributions. And that is where mutual funds, portfolio managers, et cetera, all have to distribute their gains for the years, whether it's capital gains distributions, which they'll have a lot of this year, any type of dividends and interest income. So if they're a balanced fund of some sort, they got to issue out their dividends and interest income. Real quick side note to this: if you own mutual funds, right? I get a ton of emails every year, usually from exactly the same people, freaking out because one day over the next couple of weeks, your mutual fund's going to drop by $1 and the market will be up or whatever it's doing. You're like, why is my mutual fund down $1? What happened? That's the distribution.
The distribution.
In a couple of days, you'll get, if you don't reinvest dividends, you'll get a check in the mail. Literally, you're going to deposit into your account of cash for the amount of that distribution. Or if you do reinvest your dividends, now this is in mutual funds. This is not ETFs. This is not individual stocks. This is in mutual funds. So if your investment has 5 letters on it, it's a mutual fund. If it ends in X, it's a mutual fund. You'll get shares if you reinvest your dividends. So in a couple of days, you'll have a big price drop one day, and in a couple of days, you'll either get shares or cash, and it'll balance itself out. So this is what's going to happen over the next 2 weeks.
Don't freak out.
Don't freak out. Just part of the process. So there's a couple of things. So again, markets are fine. We're pretty deviated from the 20 and the 50-day moving average, which is another reason I think over the next couple of weeks that we're going to get a bit of a correction, probably back to the 20. So maybe come back down to 6,000, maybe go to 5,900, depending on the size of the correction. Now, what would cause that correction? Give me 1 second. I'll be right there. I think we have that. Then that sets you up for that year-end, last 5 days of the year, Santa Claus rally, as portfolios, now that they've done their distributions and they've rebalanced their portfolios, they've got a window dress for the end of the year to make sure they have all the right stocks, the right investments, those type of things for their annual reporting. So why do I think that there could be a correction in the next couple of weeks? This chart is the blue line is the one to pay attention to. This is the stock bond ratio. This year, the markets are up 28%. If we take a look at AGG kind of as a proxy for just kind of a global bond index that owns corporate treasuries, kind of everything for the bond market, it's up about 3% this year. So if I own a 60-40 allocation model, so I'm a portfolio manager that has a 60-40 allocation, my allocation right now is 65% stocks and 35% bonds. So going into the year when I report, I've got to sell off 5% of my stocks and buy 5% of the bonds to get it back to 60-40. So that's going to provide potential. This is why I'm saying over the next 2 weeks, we could run into a little bit of selling pressure here. Nothing dramatic, but enough selling pressure here to bring the markets back a bit as we go through that distribution period as these portfolio managers rebalance. Right now, that stock bond ratio is around 6.7, 6.5 and 6.47 right now. So call it 6.5. That stock bond ratio normally trades somewhere between 1.25 to about 2.5 normally. So we've had this massive, since 2020, we've had this massive expansion of the relationship between stock prices and bond prices. So potentially there's a lot of fund managers out there that are way overweight equities right now and underweight bonds. So we may see a bit of that occurring over the next couple of weeks. That could lead to that pullback. And then they rebalance that portfolio and get all the right positions for the end of the year. And that's how you get that buying into the last 5 days of December, first 5 days of January. Beyond that, I have no clue what's going to happen.
Okay. And so you might expect to see equity prices go down as they're selling their excess exposure to stocks.
Right.
Do you expect a commensurate rise in bond prices?
Well, bonds have actually been rallying. And again, some of this is going on now, right? We've seen bonds, kind of rallying. They're up 4% last week. So stocks have been a little bit choppy. They've kind of been all over the board. We kind of open up in the morning, sell off in the afternoon, kind of rally back in the afternoon, that type of thing. So some of this is going on now. It just normally in the next 2 weeks is when that distribution starts to occur. And normally, if you just look at the average return of markets over history, you tend to have a dip in stock prices in the second 2 weeks of December. That's where those distributions are going on. So some of it's going now, and that's why I think we're seeing money rotate into bonds now, and we're seeing that kind of rally over the last week.
Okay. All right. Well, then our typical ending topic here then. So given all this, what trades have you guys made over the past week?
None. We went into Thanksgiving, overweight equities, just a smidge, not a whole lot. And, the portfolio is doing great right now. We're kind of balanced between, we talked about this before. If you look at the market from one day to the next, Mike and I kind of have this analysis, like it's a Dow day or it's a NASDAQ day. And some days you look at the heat map of the market and it'll be Apple, Nvidia, Google, Microsoft, Amazon. Those are all green and kind of everything else is red to some degree. That's a NASDAQ day. Other days, those stocks will be red and everything else is green. So that's a Dow day. And we've been having those alternate over the last couple of weeks. And our portfolio is kind of balanced between those. We have, Eli Lilly and AbbVie and we do own NVIDIA, Microsoft, and Apple, and Amazon. We own those guys. And we also have some other stocks in the portfolio that are kind of less well-known, like OneOK and GE Vernova and some other stuff like this. So we kind of see this rotation jumping around the market, and the portfolio has been able to capture that. So we haven't really had to do anything to any great degree. Unfortunately, we don't have any losses this year to sell. So we're not going to, our tax loss selling is going to be pretty minimal. And then, kind of moving into the year, it'll be just a function of kind of rebalancing over the next couple of weeks. Hopefully we get a bit of a pullback because there's a few stocks we'd like to add to for that end of the year. So so over the next couple of weeks, as you and I talk, I may have some trades for you.
Okay. So you might plan for a little short-term sprint at the end of the year, like last week and a half. Okay. Yep. We'll go along and try to capture that Santa Claus rally.
Yeah, absolutely. We'll try to bring our weighting up a little bit. We added some small mid cap a couple of weeks ago. It really hasn't done a whole lot. It's been just back and forth. We added a little bit of previously we had added like financials like JP Morgan. That's done well. So again, we're pretty well allocated, but yeah, we might want to up that allocation just a bit just to kind of capture the year end, because next year I think it's going to be a much more volatile year where gains are going to be harder to come by. So I want to try to book as much as I can this year where things are pretty clear.
Okay. A question that I don't want to get into now because I think it might require, sufficient time to really answer well,
Sure.
but is how relevant is the Dow? I was a little surprised when you said NASDAQ versus Dow day versus NASDAQ versus S&P day, right?
Okay, don't read into that. No, we're not looking at the Dow Jones. It's just when it's kind of just a identifier for us is that a Dow day is stocks that aren't in the NASDAQ.
Okay. But I think it's an interesting question because we still have the Dow Jones Industrial Index, right? And they just recently they added NVIDIA to it, right?
It's no, it's it's a shame. I think it's a shame that S&P Global, who runs that index, has done to that index what they've done. Because it used to be you could look at the Dow Jones Industrials, and this is my opinion, so just take it for that. If I was S&P Global, so S&P Global, they have the S&P 500 index. They have a billion different indexes, right? They started kind of trying to re-engineer the Dow to play catch up with the rest of the markets, but that wasn't the value of the Dow. The value of the Dow Jones Industrials was it was a measure of industrial companies.
Right.
Then you had the Dow Jones Transportation, and you had Dow Jones Utilities. In my opinion, you should have kept those pure because you could use those as tools to measure market activity. So I can say, well, how are the industrials doing versus the transports? Because if I'm doing a lot of industrial production, right? If the economy is really ginning and I'm producing a lot of industrial goods, I've got to transport them. So those should all be going up together. And when there's deviations between those two, people are speculating in industrials, but transportation is dropping. Maybe there's something going on economically I need to be more aware of. But now they've really bastardized that particular index by adding Apple and Microsoft. Those aren't industrial companies; those are tech. So you've deviated what that index was supposed to actually represent. And then S&P makes other mistakes like adding super microcomputer when it's at its peak, into the S&P 500, only to watch it collapse by 70% in the next, couple of weeks. It kind of makes you question actually who's running these indexes because it looks more like people just trying to chase returns so they can get a better look on the index, right?
Right.
Creating an index that's the purpose of an index should be to give you a representative value of what's happening in a sector or in an overall market. And it should be well divided amongst all it. So if it's the S&P 500 as an example, I would restructure the S&P 500 to be representative of the actual weights of the economy in different areas. How much of the economy is made up of industrial stocks? How much is made up of technology? How much is made up of that? And I would maintain the weights relative to the economy, so I had a representation of what was actually happening in the economy. But again, I don't run the indexes.
Right, and S&P is market weighted, so you look at it and it's really a reflection of what are the big tech companies doing, and the rest almost doesn't matter.
Chasing what, right? So, super microcomputer was the largest market cap weight in the small cap index before they moved it to large cap, and then it became a small cap again. The market weight, and again, how you weight them is, the Dow Jones is price weighted versus the S&P, which is market cap weighted. So, is there a better way to weight? Is one better than the other? That's a conversation for another day. But yeah, I just think there would be a better way to create indexes that could be more representative of what the economy is doing, which is what we're investing in.
All right. Well, thanks for clarifying that for folks. All right, Lance, going to start to land the plane here. I'm going to try to squeeze in a rant here. We'll see how this goes. Very quick. So I was listening to, so I want to have this next discussion as apolitically as we can. I'm not trying to make a political point here. I'm trying to make more of an ethical one. So we had the surprise, we had the controversial pardon happen this week of Hunter Biden by President Joe Biden. And regardless what you think about that, it obviously stirred up a ton of discussion. And I was listening to a program where the host was, really grilling some of the Democrats who had been, echoing Joe Biden's comments that he was not going to pardon Hunter, right? And I don't want to get into whether the pardon was right or wrong or whatnot. But what was interesting is most of the people who were, trying to answer that question were saying, well, look, at the end of the day, it comes down to a father wanting to do, everything he can to protect his son, right? And what was interesting to me was, even the host, I think it was Piers Morgan, so it was a big guy with a big brand name, and he said, okay, look, I want to drill into the legality of this, but he said, look, being honest, I might have done the same, and to protect my sons. I know he's got 4 kids or something like that, but basically the question came up was like, what would you do? What lengths would you go to shield your child from the law? And it was like, and it was asked, if your son were to have murdered somebody, would you help them evade the authorities? And what was interesting to me is in that conversation and a few others that I heard sort of similar questions raised, a lot of people said, yeah, I'd protect my child. And I was kind of like, really? Like, I can see certain things. If you think your child's being unfairly prosecuted or whatever, you might help them, evade the law. Maybe you're a pacifist and there's a draft and you want to help your child get across the border. I can see lots of examples like that. But just like straight out, like, crime, murder, like, would you actually be able to justify that? And if you feel like you can, then you kind of open this Pandora's box of like, well, then anybody in a position of power should do what they can clearly to favor their children, right? If you're a principal of a school, yeah, and your kid gets in trouble, well, you're gonna pull them out and make sure the kids, you're gonna protect them from those implications. If you're a judge and your child comes before you for having committed a crime, well, of course you're going to give them extra leniency because you're their parent, right? You open this really dangerous Pandora's box that lets anybody abuse whatever power they may have. Well, of course, a congressperson's going to direct slush money to their family members, because why wouldn't you if you're their family, right? So I'm curious, Lance, to me, it all came down to like this topic of accountability, right? That I hope I'm never in that position, but if I am, I would like to say, look, my child has to learn to be accountable for their actions. And if they did something illegal or potentially horrific, I'll have all sorts of ways in which I'll try to help them mend and repair as a parent, but I'm not going to shield them from the consequences of those actions. So curious, I know accountability is probably something you care about, and you and I, it's relevant to the world of investing, because as an investor, if you're continually shielded from the bad decisions you make, you're never going to learn how to be a good investor, right? If you have a parent or someone who's continually bailing you out, you're never going to be good at learning how to manage money, right? With kids, if you shield them from accountability, they're never going to learn how to live a moral life. So anyways, curious your thoughts.
I've talked to you about how I raise my kids and what I expect from them. And my kids are very clear on this. And when they leave the house, I go, don't add to the population, don't subtract to the population. If you get caught and arrested, don't call me, because I'm not coming to get you. I will not bail you out of jail. I will not come get you. You are on your own. Do not call your mom. Do not call me. That phone is shut off until you solve your own problem. Because the way we learn from our mistakes and the way we grow is through the pain of that process. And if you deny them that pain, they don't learn to grow. They don't learn to adapt. And this has been the side effect of soft parenting now since Dr. Spock and his thesis about not punishing children, right? We've gone through this whole phase of soft parenting, which has led to a lot of the problems that we have in discipline in schools, discipline in society, etc., because people are shielded from the consequences of bad action, right? If you shoplift at a store, there's no consequence for that. If I beat somebody up, there's no consequence for that anymore. And so you perpetuate bad actions by not providing a repercussion for those bad actions. So, and when we were growing up, I don't know about you, but when I was growing up, I grew up in a household where it was spare the rod, spoil the child type mentality. And if you messed up, there was a direct, immediate, and forceful consequence. And guess what? You didn't do it again. And I guarantee you that if my father was still alive, he would tell you, yeah, if Lance went to jail, he'd be in jail.
Mhm.
There was no bailing you out. And it was interesting because I was talking to a gentleman last night, and he goes, I disagree with you about the way you raise your children. And I go, that's fine. It's the way I raise my children. My job as a parent is not to be all warm and soft and fuzzy. My job as a parent is not to be my children's friend. That is not my job. My job is to ensure that they are happy, healthy, productive, law-abiding citizens in this country, and that they contribute to society, not detract from it. They don't add to the population. They don't subtract to the population. They don't create despair or disparity on others. That's the goal that I want them to learn. Now, and again, you may disagree with that. You may think that's too harsh, but my job is to provide productive, good, healthy citizens for this country so that they can help move things forward, not backwards.
All right. So your upbringing and your parenting style is very similar to mine. And I think the reason you do that, right? Again, it all goes back to this term of accountability. I mean, I think that's why these 12-step programs, right? You've probably been contacted people going through things like AA, where there's some stage in there where you have to call everybody that you feel like you've wronged or impositioned because of your alcoholism and apologize for it, right? I think the AA meetings that you start, right? Every meeting, when they say, okay, who's here? And before you say your name, you say, I'm Lance Roberts and I'm an alcoholic, right? And it's all about taking accountability, right? Because it's sort of like the classic, you can't start to solve a problem until you admit you have it, right? And so if you help people avoid admitting that they have a problem or shield them from the consequences from it, there's no accountability and the behavior won't change, right? It's funny, she'll kill me for mentioning this, but one of my daughters was home for Thanksgiving, and she's started to catch the fitness bug, which is great because her mother and I have been modeling this and trying to encourage it for a long time, and she's really getting into it now. And she's got a couple of friends who are like physical trainers, and so she worked out with them a fair amount. But then after she went and worked out, they all went to a bakery and had really nice scones, and I was kind of trying to politely tell her, like, look, if you're trying to improve your health and your level of fitness, it's wonderful, and I want to do everything I can to support and enable that. But like, you got to understand that you're just like totally you get these eating habits that are totally self-sabotaging you here, right? And until that light bulb went off in her head and she could take accountability and say, okay, yeah, you're right. I guess if I really am serious about this, I really got to stop doing some of this other stuff that I like. And of course that was a rough conversation for a father to have that kind of conversation with their daughter. It's always super dicey. But again, it all kind of at the end, it all comes back to accountability for your actions and, what are you trying to do? And if you're trying to become a better person, you got to look at the stuff you're doing that isn't putting you on the trajectory to be a better person. All right, I think we did a pretty decent job of talking about that without getting too political. So I appreciate that, Lance. And again, your role here on the channel, I do want to give you again some gratitude that your job has been to kind of hold people accountable for their biases on this channel, because many times over the past years, you have said, hey, I get it. I get the emails from everybody saying the world is going to hell in a handbasket tomorrow, and it has to for all these reasons, right? And you gotta try to pull yourself out of the bearish worldview or the bullish worldview and really try to be the eagle and understand that in any horrible situation there can still be opportunity, and that when, like today, when times are going great, you gotta be honest with yourself and say, look, when the getting's too good, there's probably some price you're going to have to pay. So just don't blindly assume that tomorrow's going to look just like today. So you do a really good job of keeping us regular investors accountable to our biases.
I'm actually writing an article for an upcoming week. I think it's next week, maybe, talking about me being a perma bear, because I've been getting all these emails lately saying, Lance, you're just a perma bear. You're like Ed Giardini. I'm not a perma bear at all. And I will be the first to tell you, if we start seeing the signs of this market really breaking down, I will tell you it's time. We're cutting risk.
Sorry, you said perma bear, but I think you meant perma bull, right?
Sorry. Yeah. So yeah, I'm not either. But people tend to when I'm, every week we're on the show, we're talking about the market going up, and I do present a bullish spin here on with you over the last couple of years, in particular, because the markets have been bullish. When that changes, I will change, and I will not get the top. I will tell you this, that the market will roll over. I'll tell you that it's probably just a correction. Everything's fine. Don't over panic. And then we're going to break some level of support. And I'm going to say, okay, now it's time to panic. But you're not going to get the top. But that's how we navigate markets. So I will ensure you that as we go through the markets over the next 2 years, 5 years, however long you and I are doing this, that I will tell you what we're doing. And if I make mistakes, I will let you know. And we'll navigate this together. But that's the only thing I can do, because as we've talked about before, people that make predictions, it's fine. If you think Bitcoin's going to 1 million, right? That's great. It has to be definable, it has to be actionable, and it has to have a time frame on it. Because if somebody tells you, oh, the market's going to crash, well, great. What does that mean? How much is it going to crash? Why is it going to crash? And when will it happen? And if you can't put a definition on that, then it's just a wild ass guess. It doesn't do you any good as an investor. And that's why when we talk here on the show, Adam, everything we talk about is like the next 2 weeks, this is probably going to happen. Or the next week, we expect this to happen. And it's all short term, because that's all we can predict. That's all we can define from the data is most likely what's going to happen over the next 1 week, 2 week, 3 week, maybe 4. But outside of that, it's just a guess.
Yeah. All right. Well, look, just ending the point on accountability. Again, one of the reasons why I love talking with you, Lance, and other people who manage capital is because you have to be accountable to your clients. You're not just slinging opinions here. You're actually having to take action on it and report back to people about how you did with their financial future. Right. So, all right. Anyways, again, thank you again for being so generous with us through this program in terms of, just being as transparent as you are about how you see the world and the decisions that you're making.
Right.
All right. With that, folks, if you feel like a great way to make yourself more accountable towards your goals in life is to commit to watching Lance Roberts on this program, not just for the next 2 to 5 years, Lance. I mean, you're about to turn 60. We're going to be doing this when you're 80, buddy.
All right. Great.
If you feel that's the best way for you, then show that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you want some help in navigating what may lie ahead here, especially given how Lance has described the landscape that he's looking at here and what he expects to do and how he expects to react, highly recommend that you get that help from a good, qualified professional financial advisor. If you'd like some help from one of the ones that Thoughtful Money endorses, perhaps even Lance and his team there at RIA, just go to thoughtfulmoney.com, fill out the short form there. The firms will be reaching out to you momentarily after you do that. Also, while you're there at thoughtfulmoney.com, don't forget to hit the newsletter link right at the top of the site. You can sign up for our free newsletter that way. And a reminder that if you are thinking about upgrading to the premium version of the newsletter, do so soon, because the price of that is going to increase at the end of this month. It's going to go from its current $15 a month price to $19 a month. I want to make sure everybody gets the lower price and gets grandfathered in on that. And as a reminder, if you subscribed earlier, like last year, for the much lower price that it was back then, as long as you remain a subscriber, you're going to get grandfathered in at whatever price you're currently paying. So you're not going to get impacted by this rate increase. All right, Lance, as usual, I'll let you have the last word.
If you wind up in jail, don't call me. So that's
okay. Thanks. Yeah, you were on my list of guys that I would call if I was in trouble like that, but I'm now deleting you off my phone for that.
Exactly. You should. No bail money from me. No, again, y'all have a great week, and don't forget that we are approaching Christmas rapidly. Amazon is now taking like 3 and 4 days to deliver stuff, so don't wait till last minute to get that Christmas present for your wife, because it won't be here on time if you do.
That's a great reminder.
This is just a friendly man advice to keep you out of trouble.
I appreciate that. Another little bit of friendly advice, and I'm probably going to get some blowback from the purists on this. But my wife finally ground me down, and we finally went artificial tree this year.
Huh?
Game changer. It looks great, and it's so much easier. And when you run the numbers out, it only takes a couple of years before you're positive on the investment. I'm liking it much more than I thought I would.
Yeah. So I was a real tree guy until I married my wife almost 15 years ago. And she's a Christmas fanatic, mind you. So when it's Christmas time, this is her time of the year. We have generally, 3 or 4 Christmas trees around the house.
Oh, well, yeah.
Various different sizes, ornaments everywhere. Christmas is a thing with her and my daughters. So for 15 years, I've been an artificial Christmas guy because I refuse to clean up all the needles. And especially with all the fire hazard that she creates, artificial is the way to go.
Is the way to go. Is the way to go. And I will say too, like for me, the biggest issue is, and you're saving a tree, which is just nice too, but is the lights. We had this very complicated. You wrap the trunk first real tightly, and then you do lights around because you want to have the tree be fully displayed. Right? It just took forever, and then of course at the end you had to undo all that, and it would always tangle, and a light would break, and then the whole string would go. It's just so nice to just assemble it in a couple minutes and be done.
Yeah, it is. It is. Well, welcome to the dark side. So,
all right, thanks. All right, folks. With that, hope you guys are all staring at wonderful holidays coming up. Lance, thanks so much again this week. See you on here next week. Yes. Everybody else, Merry Christmas early, and thanks so much for watching.